In December 2001, the financial architecture of Argentina collapsed overnight. Without warning, the government froze bank accounts. For the middle class, a lifetime of savings evaporated in a matter of hours. They were trapped. But if you look at the capital flow data from 18 months prior, you will notice something chilling. The ultra-wealthy weren't trapped. They had quietly moved billions of dollars into offshore accounts in Miami and Zurich. They didn't survive by reacting. They survived by diagnosing the rot in the system long before the floor gave out. Narrator. The mainstream media sells a comforting lie. They tell you that financial crashes are unpredictable black swan events. They claim that nobody saw the 2008 housing crisis coming. But the forensic data tells a completely different story. Most people think a crash is a sudden, unpredictable accident, but a real crash is a highly orchestrated, scheduled transfer of wealth. Narrator. The ultra-wealthy, the 1% of the 1%, do not experience economic collapses the way the retail public does. They operate on an 18 to 24-month lead time. By the time the panic hits the evening news, their preparations are already complete. Today, we are opening the patient. We are conducting a forensic autopsy of 2008 and contrasting it with the flashing signals appearing in our system right now. Welcome to Financial Forensics. Let's diagnose the present. The forensic diagnosis. To understand how the ultra-wealthy prepare, you first have to understand the mechanics of the collapse. You must stop looking at the symptoms and start looking at the plumbing. What we experienced in 2008, and what we are entering again today, is known as a Minsky moment. Named after economist Hyman Minsky, this is the exact point where a prolonged period of market stability creates so much reckless, speculative debt that the underlying collateral can no longer support it. In 2008, the architecture failed because the foundational asset, subprime mortgages, turned toxic. But the collapse wasn't a glitch in the system. It was the system functioning exactly as it was designed. When a Minsky moment arrives, we enter a doom loop. This is where asset values drop, forcing banks to sell off other assets to maintain liquidity, which drops prices further, creating a vicious cycle of forced liquidation. Narrator. The retail investor is taught to diversify, a mix of stocks, corporate bonds, and mutual funds. But the ultra-wealthy understand the terrifying reality of asset correlation. In a severe liquidity crisis, the correlation of all risk assets goes to exactly 1. Everything drops at the exact same time. We saw this contagion spread globally. Look at the European sovereign debt crisis that followed 2008. The mainstream told Greek citizens their pensions and local equities were secure. In reality, over the ensuing years, Greek equities suffered a staggering 92% loss in value. The middle class was eradicated. But what was happening behind the scenes? Hedge funds and institutional players were quietly buying up distressed Greek debt for pennies on the euro. They weren't panicking. They were diagnosing. They saw the architecture failing. Today, the flashing red signals aren't in subprime residential mortgages. They are in heavily leveraged commercial real estate and sovereign debt. The architecture is groaning. The 2-4-month countdown has already begun. The radioactive versus underlying assets. When the institutional countdown begins, the wealthy initiate a silent migration. They move capital out of what we call radioactive assets and into underlying assets. A radioactive asset is anything that relies on a chain of counterparty promises to hold its value. If your wealth relies on an institution remaining solvent, you do not own an asset. You own an IOU. This includes over-leveraged paper real estate, complex derivative bundles, unsecured bank deposits above FDIC limits, and even institutional credentials that hold no tangible value in a contracting economy. Narrator. The ultra-wealthy rotate into underlying assets. These are assets that possess intrinsic, uncounterfeitable value regardless of what the stock market does. We are talking about productive land, physical commodities, energy infrastructure, and vital skills. Have you ever wondered why billionaires like Bill Gates and massive institutional funds have been quietly accumulating over 270,000 acres of American farmland? They are not doing this to become farmers. They are doing this because productive farmland is the ultimate institution-proof asset. It yields food, it holds tangible value, and it cannot be printed into oblivion by a central bank. But you don't just need hard assets. You need liquidity. And this is where the retail investor radically misunderstands cash. Retail holds cash in checking accounts to pay bills. The 1% hold cash as a weapon. In the 18 to 24 months before a projected collapse, institutions hoard short-term sovereign debt, specifically U.S. Treasury bills. Why? Because T-bills aren't just a safe haven, they are ammunition. When the doom loop triggers and asset correlation goes to 1, highly leveraged retail investors and overextended corporations are forced to liquidate their assets at fire sale prices just to survive. If you are sitting on a war chest of T-bills, you are holding the dry powder. You are holding the exact ammunition required to sweep in and buy generational assets, real estate, businesses, equities at 10 cents on the dollar. The wealthy don't view a crash as a disaster. Because they hold ammunition, they view a crash as a scheduled shopping event. The strategic playbook. So, how do you stop acting like retail liquidity and start acting like an institution? You implement the strategic playbook, and to do that, we look backward to look forward. We apply the 1,929 strategy. In 1929, thousands of retail banks collapsed. The middle class, trusting the mainstream narrative, went down with the ship. But the smart, silent money had already moved. They shifted their capital out of fragile retail banks and into the United States Postal Savings System, an institution directly backed by the federal government. Between 1929 and 1933, the Postal Savings System saw an astonishing 800% growth in deposits. The smart money recognized counterparty risk and eliminated it. Your modern playbook requires layering your liquidity. Layer 1. Never exceed FDIC or NCUA insurance limits in any single institution. Layer 2. Utilize Treasury Direct to hold short-term T-bills. This removes the commercial banking layer entirely, placing your ammunition as close to the source of fiat creation as possible. Layer 3. Maintain a strict reserve of physical cash. When digital systems freeze, as they did in Argentina, physical liquidity is king. But financial capital is only half the equation. You must also develop institution-proof skills. If your only marketable skill is pushing emails around a corporate bureaucracy, you are highly exposed to a systemic contraction. The ultra-wealthy employ people with hard, unforgiving skills: monetary translation, physical repair, logistics, energy production, and food cultivation. If you do not have the capital to buy 270,000 acres of farmland, you must become the person who knows how to optimize it, fix its machinery, or secure it. Invest your current fiat into hard skills that retain their premium in a depressed economy. The closing summary. We are currently sitting in the 18 to 24 month window. The architecture of sovereign debt is fracturing. Commercial real estate is staring down a wall of refinancing that it cannot afford. The mainstream media is telling you the economy is resilient, while institutional insiders are quietly rotating into underlying assets and stockpiling their T-bill ammunition. The tragedy of 2008 wasn't that wealth was destroyed. It's that wealth was simply transferred from the uninformed to the prepared, from those who trusted the narrative to those who understood the mechanics. Crashes are not the end of the world. For the prepared, crashes are highly lucrative, scheduled shopping events. Narrator. History isn't the past. It's a running diagnosis of the present. Subscribe so you don't become the next case study.